Greetings from our team at Robare Jones Wealth Management. This is Jack Jones, the managing partner, with our October monthly market update. Before we begin, we want to thank our valued clients for the trust and confidence that they place in us. The best part of our day is time spent directly serving you. Some local sports headlines. We want to congratulate the Houston Astros and wish them success as they continue in the playoffs, and also congratulate the A&M Aggies for their football win against Alabama recently. I think I can hear the whoop in the background. We also encourage you to attend our 12/1 in-person client event at Perry's over lunch. We already are close to capacity, so if you haven't RSVP'd already, please do that, and we're very much looking forward to seeing you there. We also hope that you've had a chance to participate in some of our webinars this year. We've done everything from Medicare to cybersecurity, charitable planning. We have one in November upcoming on Social Security. So we hope that you participate in those and find value from the information we share there. So it's been 1 year ago since we began doing these monthly market updates. So we hope you enjoy them. We try to keep them brief and to the point, covering the topics that are relevant to the day. Here's to the next year and beyond with our monthly market updates. So September was a bad month in the market. September is historically a bad month, and it was so this past month, ending 7 consecutive months of growth. The broad market was roughly down in September. So China was in the news for all the wrong reasons recently, including property developers like Evergrande, who was rumored to not be able to make a debt service payment. So for those reasons and others, as we approach the emerging markets, a position that we recently added to our allocations in our recent rebalance was emerging markets for areas that we like, but we took China out of that. So this position is what's called an ex-China position. So for the reasons cited and others, kind of an enhanced geopolitical risk, we don't have any dedicated weight to China at the moment. So inflation is everywhere. Let's kind of start with a definition, which is inflation is decreased the purchasing power of money because prices go up. Another definition is too much money chasing too few goods. Inflation is finding its way kind of everywhere as we approach the highest at an annualized rate 5.4 in 13 years. You see even inflation affecting Dollar Tree, which can't be any longer soon saying everything's $1, as it looks like even the Dollar Tree will be going up in prices over the next few months to anywhere between $1.25 and $1.50. Also, you see inflation in the cost of living adjustment for Social Security that's going up 5.9% in 2022, the highest increase in 40 years. And if you need any more proof that inflation is a significant issue, you just need to look at the S&P 500 companies that are mentioning inflation as an item in their Q2 earnings calls. A full 224 S&P 500 companies are referencing inflation as they approach their both past and forward earnings. So if inflation's running hot and if that persists, what's the counterweight to that from an allocation perspective? And what you see is the type of stocks and bonds that typically fare well or better during an inflationary environment. And we've seen this materialize this year with commodities and energy stocks. And on the bond side, things like emerging market bonds and high yield. The September jobs report was not good. The expectation was over 500,000 jobs. Only 194,000 were added, bringing the unemployment rate down from 5.2 to 4.8, but for the wrong reasons, which is fewer people looking for work. And in fact, a record 4.3 million workers quit their jobs in August. So while we have a at 10 million available jobs, we're only adding 200,000 a month per the last jobs report. So that's a significant imbalance. There's a lot of reasons for that we can't go into today based on time, but something very closely that we're watching going forward. But the fact that 4.3 million people left the labor force in August and quit their jobs is a significant item. So where does all of this leave us? One of the things that we've seen is a recent pullback in markets, some 3-4% from all-time highs. Part of what is balancing that out a bit is the fact that there's still $4.5 trillion sitting in money market assets, earning a negative real return as inflation picks up. So that's another thing to watch. Our goal from a capital allocation standpoint is to allocate assets in a way customized to your specific preference and profile and circumstance to create the highest probability of success over the widest range of outcomes. Now, the things that are driving those outcomes are always changing. So that's why we both need to be in frequent communication. And that's why we make the changes that we do as markets change. So if you have any questions about any of these items discussed, please reach out to us. Know that we're following and monitoring all of these items very carefully. And again, please reach out to us if we can help you out in any way. Until we see you again, hopefully in person, stay well and take care.